Hello, my name is Brian Overby. Welcome to Options Guy TV. So this week we had a theme of short spreads. We looked at a short spread in the SPY, the good old S&P 500 index ETF. And then we also came out and we looked at another we legged into a spread in the USO. That's what we talked about on Wednesday, which was we're trying to try to break out in oil, and we looked at that trade. So the SPY trade that we are looking at is a longer term trade. We're going to take the time to actually manage the trade if we have to. And then today, we're just going to go on the opposite side. So I look for a stock that I would consider selling a put in. And so we're going to do a short put spread, and we're going to do it on Exxon Mobile. We're going to do it on an underlying that, well, in this day and age, we saw the breakout in oil, and we traded that breakout. We did a paper trade in that. We bought a long call option. Then we legged into a long call spread. And ideally, that trade would probably still be on. And we're still getting a good solid move to the upside. We talked about maybe not legging into the spread. We just wanted to talk about here's what we could do if we wanted to take some money off the table, but still give us some upside. All right. So in Exxon Mobile, we're going to take the approach that, hey, we'd like to buy the stock. And we're going to sell a put spread with the intention of buying the stock, much the same as a cash secured put. And that's the way that we're going to approach this trade today. And once again, because we wouldn't mind buying the stock, we'll probably go out a little bit further in time and bring in a decent credit to try to help pay for the stock if we do get put that stock. Okay, so let's go and look at the TradeHawk software. I have it up right now, and I'm going to start by looking at a couple of charts. Okay, so in the SPY, we have a pretty big downturn, right? So here is the 20-day moving average, which is a lot of people have been talking about that we might get a little bounce off of the 20-day. Here's the 200-day down here. The 50-day, and here's the 20-day up here. So we've made that strong move down so far. Almost from the day that we put on the trade, we've really had either chop or down markets. So if we go back and look at that, the trade in the SPY, here is the actual trade in the what if scenario inside the TradeHawk software. We sold the 62 strike, right? So we sold the 62 strike, which is right there. And then our protection, we went out 3 points and bought the 65 strike. So you're talking 462 is the one we sold, 465 is the one that we bought. Got the underlying stock down here. There's really nothing to be nervous about at this point in time until we get closer to this range, somewhere up in as we approach that 462 strike. If the market did bounce back, well, then we would consider rolling the trade or adjusting the trade into a different type position. Hasn't happened yet. So I'm going to actually I'm going to send this trade over to the trade ticket, and let's just look at a quote on it, because all we want to do is maintain this trade now. So let me go back. What if? I got to click these two buttons. Boom, boom, and send a ticket. I hope that did that for us. All right. Well, I do know that if I look at that trade right now, it's trading for right around 60 cents. I have that in my notes. And if I put that trade on, that trade was around 90 cents when I first put it on. So let's set it up. Let's take a peek at it. 465, we went out quite a bit in time. We still got 40 plus days remaining. So we're looking at the September, the date was September 22. Okay, so here's the September 22 strike. And we looked at the 462, which is right here, and we're going to hit sell on that 462. And then we're going to buy the 465, and that's right there. And then we're going to be buying that one. So when we initially put on the trade, we did it for a net credit to the account of 90 cents. We had 3 points of risk. That means that our max risk was $2.10. Now we've had the markets come off, but we're a longer term option contract. And so that hurts us to start with when we're correct on our forecast, because we've gone down quite a bit since we put on that initial trade. And so far, we've only gained 30 cents on that trade. So we would just stay the course. We would look unless we're making close to, unless we can buy it back to close it somewhere around the 20-cent level or the 15-cent level, we just want to stay the course on that trade. Now, if the market went against us, the time premium helps us, right? So it's kind of a catch-22. So if the market starts going up and we have a lot of time left, that allows us to hedge our position or roll our position. That time premium actually helps us out. So far so good on the SPY trade, and we'll leave that one there, and we'll move on to today's trade. So now let's look at Exxon Mobile. Okay, so this is our second time talking about Exxon Mobile. When we did the week where we focused on long call spreads, that was an earnings week. It was actually quite a few companies were announcing earnings that week, and Exxon Mobil was announcing on a Friday. So because of that, they were announcing before the open on a Friday. We wanted to do a speculative short-term trade that only lasted one day. And if I look at the chart, let me go back to the chart, and I find this real interesting because we were looking at oil and what's happened with oil. It had a real strong move in oil and all that. So we thought, well, maybe Exxon Mobil will have a decent earnings report, and maybe we'll get a little pop-up after their earnings. And if we look at the chart here, and I'm going to highlight a couple of things on here. I got a Fibonacci number and stuff like that. But right here was their earnings. So what happened was they announced on Friday on the open, they were down on Friday, and then it kind of catapulted them straight up on Monday. So the market had we were on the one day we were long call spread, and this is a frustration of option trading. And we only had one day to live, and we did that as a speculation just to try to learn a lot about how a long call spread works and how it gets priced. And then on Monday, all of a sudden the market was right back up where our short strike was on our long call spread. In other words, the market came all the way up to our short strike, right where we wanted it to be, but we were a day late and $1 short on that one. But so I'm going to come back and revisit it. So 108 was our strike, which is right where the 200-day moving average is. And that's part of the reason why we sold the 108 strike, is that we thought maybe there'd be a little resistance to the upside right around that 200-day moving average. But then we've had a strong move up, and right now we're at 111.51. So a real solid move since their earnings report. And I did a little Fibonacci coming off of this high down to this low, and we're right at that 50% retracement level, and we've broken out above that level too. Also, real interesting area in here. Here's a gap. We saw this gap happen over here. Then we had a gap down, and it filled to the downside. So it's just an interesting, this is the one sector of the market that most recently has outperformed even a lot of the tech stocks. Tech stocks have had a great run this year, no doubt about it. Apple, Amazon, they all did well over earnings, Google too. But right now, what's kind of leading the markets higher are a lot of the energy companies, and hence the reason why we're going to talk about a paper trade in Exxon Mobil. But charts definitely interesting in Exxon Mobil. So let's go in and actually look at our options grid and discuss how we would set up that trade. All right, so right now I have the September expiration up. That's too far out. We're going to do this trade kind of hoping that we come back down close to that 200-day moving average, and we want to buy the stock. So the reason why we're going to set this trade up this way is that we're intending that we would like to buy 100 shares of Exxon Mobil. So if you do that, that also means that you have to have the ability to buy the 100 shares, right? So I need to have whatever the strike price is times 100 to be able to buy the stock. That won't be our requirement on the trade, but that's what my mindset is. I'm going to go out about 30 days because I'm hoping the stock will come down to that level within that time. So I'm giving myself a time frame that it will work at, right? I'm giving myself a time frame that if it does come down, hopefully I can get put the stock within that time frame, right? So a lot of times if I'm doing it, I'm looking at anywhere from 15 to 30 days. Even if I was doing just a flat out cash secured put, I'm looking at 15 to 30 days, because if it doesn't come down, I want to put on another trade, right? And I want to try to buy it. Or you just let the options expire. You made money on your options, but then you missed out your opportunity on the stock. That would be the downside of it. All right, so let's look at this trade. 28 days is what we're going to do. We're going to do the September 8th expiration. Inside the TradeHawk software, once again, I have highlighted a 1 standard deviation move. So the green area, or I actually don't even know what color I would call that, turquoise, green, that highlights where a 1 standard deviation move would be. This side of our chain are puts, looking at the 109 strike. So I'm going to sell that strike. Now, that's only a couple of dollars below, but from looking at the chart, we want to buy the stock. So I'm going to try to be a little bit closer on that stock to where the actual underlying is at. Better chance of actually getting put the stock. That's the rationale behind that. So I'm going to be buying the 109 strike. I'm going to go down 5 points, and I'm going to be selling the 109 strike. That's going to be the driver. That means we're taking the obligation to buy stock at 109. So if I take 109, multiply that by 100, we end up with $10,900. So I want to make sure that I have $10,900 to be able to buy 100 shares of stock here. So in that instance, if I do that trade, I am saying I don't mind buying the stock there, but man, if it really takes off now to the downside, now I'm a little nervous. And so I'm going to go down 5 points, which is a wide spread in my mind. But if I'm doing this because I want to buy the stock, I don't mind going wider. So I'm going to go 5 points down to the 104 strike. And in this instance, that's our protection. So we're going to buy that. So we're bringing in $1.19 credit to put this trade on. And I'll add this to the what if scenario. So we'll look at that chart in the what if scenario. And we'll see that here's our last trade on the stock. 109 is where our risk comes in, and that's where we want to buy that underlying stock. And then we have risk all the way down to 104. So we're bringing in $1.14 on that stock. That's what we're bringing in. We'll call it $1.20. Let's call it $1.20. Let's make that this is our official paper trade for this episode of Options Guide TV. So we're going to bring in $1.20. We're going to bring in $120. Our maximum risk is $5 in this instance, which is the width between the spreads. So 5 minus 120 means that we have $3.80 of total risk, because we subtract out the net credit that we would receive to the account. But in theory, we want to be put to stock, right? So we need to have $10,900 to buy 100 shares of stock in order to buy that stock at that strike price if we do get put that stock. All right. So if I want to say, before I go into more detail here, if you have any questions, please make sure that you put them in the comment section, and we'll be happy to address any questions that you may have on the show. It could be about the previous trades that we looked at. It could be about the trades today, or a general question just about short spreads. Feel free to put them in, and we'll try to address them. We want this to be a very interactive show here on Options Guide TV. All right. So 109 to 104 is where we are at, 5 points wide, bringing in a nice solid $1.20 credit. That means that if we put that stock at 109, we're effectively buying at 107.80, which is 109 minus that net credit received of $1.20 on that trade. All right. And so if I'm doing this trade, then what's my approach to it? So let's say we put the trade on and the market goes down right away. If it goes down right away, it's a little bit annoying to me, because I wanted that opportunity to buy the stock, and I'm not going to put that stock until closer to that expiration date. And so if it does happen, I can either try to wait around and hope that the stock stays there, or I could potentially roll that underlying position if I'd like to and try to bring in a little bit more credit. That's the reason why I'm trying to get my timing right. That's why we're only going out 28 days, because if it does come down, we want to have that opportunity to buy. Might even consider doing a little bit more of a short-term trade. Oh, and I see we have a question. All right. All right. In this instance, let me put that question up. If you're trying to buy the stock, how would you set up this? If you are not trying to buy the stock, how would you set up this trade? All right. That's a very good question. Okay, so we like Exxon Mobile, and also, and that's not a bad idea, honestly, on speculation. From what we saw in the charts, kind of got a gap that wants to fill to the upside, broke through that 50% retracement level on the Fibonacci's. Even had, I think, even like had a golden cross where we had the 50-day crossover, or the 20-day crossover on the 50-day. So a lot of good things that look like on the chart right now. Not to mention just that oil is on a rally and having a good upside. So energy stocks in general are doing all right. Okay, so great question. If I wanted to do this on speculation, I guess I'll stay in this same expiration, but I might go a little bit shorter term. But we'll stay here just so that we can compare similar type trades. One of the first things that I would look to do if I'm just doing it on speculation is I'm going to go further out of the money. I don't want to be forced to buy the stock. I'm trying to avoid buying the stock. So I'm going to pay a lot of attention to the 1 standard deviation move. And also, if I'm doing it on speculation, I'm probably going to tighten my spread a little bit. I'm not going to go 5 points wide. I gave myself a little bit of leeway on the selling that put to buy the stock, or selling the put spread to buy the stock, because I didn't mind buying it, right? So even if the stock went down to 106, 105, I still was happy to buy the stock at the 109 strike and bring in the 120. I don't know. Happy would be is a relative word. I'm happy that I got put the stock, but obviously if it goes down to 105, I'm actually going to be down on that position because I'm going to buy it at a little bit higher price. But that's the concept. Okay. I went wider because I wanted to bring in a bigger credit to the account to help offset the cost of buying 100 shares of Exxon Mobile. So in this instance, I'm going to clear this trade out. And if we're going to stay in that same expiration, and I don't mind this expiration on speculation, but I'm going to look somewhere right around that 1 standard deviation move to the downside. And I see I get a decent amount of premium right at the 106. So if I was going to do this on pure speculation, I would look at selling the 106, not going as wide on my trade, and buying the 103. I'd like to get that done for about $1, and we're at at about 50 cents, and we're at 48 cents on it. So if we look down here, we're at 48 cents, and that would be the net credit to the account. I would like to do it for somewhere around 50, but we're just doing this on a whim, right? Answering a question. But so 40, so let's call it 50 and make the math simple. Say we could get an extremely good fill. We see the bid ask is 42-cent credit by a 52-cent credit. So in this instance, if the market came down, our maximum risk, if it blew through that 1 standard deviation move and went down to the 103 level, is we would have $3 minus the 50 cents brought in. That means we have $2.50 worth of risk. Our upside is 50 cents on this trade. If I could buy this back for $0.10, I'm going to. We've talked a lot about that. If you could ever take risk off the table for a nickel or a dime, you're just going to do that. But this is the way that I would approach the trade if I was looking at it for pure speculation. Go a little bit further out in time, go a little bit tighter on my strikes, and try to manage the trade that way by setting myself up to get a little bit more room for that underlying stock to move before I would have to adjust it, or maybe even just take the trade off. All right, so I got another question here. If you were speculating and the trade goes against you, would you get out or roll the trade to manage it until it has a chance to recover? Well, it would depend a little bit on how hard it went against me and how much time premium that I had left. In this trade, we have 28 days. So I would probably roll the trade. I would probably buy it back and roll it down, because let's say it took 15 days to get down to 106. If that happens, then I would consider rolling the trade. And where would I roll the trade? Would I roll the trade if it gets to 103, or would I roll the trade when it gets to 106? Or do I wait till it gets down to 100? One of the things that I don't want to do when I'm rolling a trade, especially a spread, is I want to take advantage of time premium. So my drop dead place where I'm going to probably roll this is if the stock came down to 103, and that's where then my bought option contract, my long leg, would be considered an at the money option contract, and I would get a lot of juice for it. So when you're rolling, you want time premium in the trade. The time premium protects you on any type of short spread. We talked a little bit about, I kind of hinted to that when we looked at the SPY trade earlier. So I would consider rolling at 106, but I'm going to roll somewhere between 103 and 106. That's just the area that I want to roll in. Because if it goes too deep in the money, there's no sense in rolling it. Why? There's no time premium left in it. There's no real benefit. You might as well just close the trade out and just start all over again. The main benefit when you're rolling anything, a spread or even a covered call position, is to have time premium in the trade to try to help out with the roll. And that's usually when you're losing. So on covered calls, much the same. Once it gets to the strike, I want to consider rolling at that point in time. I don't want it to get it too deep in the money, or else it makes it almost impossible to roll that covered call to a decent strike up and out and get it done for a net credit to the account. That's where the headache comes in. Okay. All right. Any other questions that we may have here for this episode of Options Guy TV? And it was short and sweet. We didn't have a trade on Wednesday. We went through a lot of detail on Wednesday's show about adjusting trades. So we looked at our USO trade and all that. It was a real great show on Wednesday. So if you want to go check that out, this is a new paper trade on XOM. We will look at this trade next week when we get into next week. We'll look at where is that underlying stock at relative to the strike price. And maybe we'll talk about an adjustment on our trade. But our ultimate goal, and this is the thought that you have to have behind this, is that we want to buy that underlying stock. It's why we sold the strike so close to where that actual stock is trading at. And that's it for this episode of Options Guy TV. Please click subscribe, ring the bell, pound that thumbs up, and we'll see you this Monday for the next episode of Options Guy TV. Thanks for coming, everyone.